by its very nature, geopolitical risk is unpredictable. Even just since the start of this year, things have happened which, I didn't predict.
Hello, everyone, and welcome back to the podcast. I'm Ed Monk, and I'm here with Tom Stevenson, Investment Director here at Fidelity, to kick off 2026 with one of our favourite things to do, which is to answer your questions. It's something we do every few months, timed to accompany the publication of our investment outlook, the latest edition of which is out this week. We've received more than 140 of your questions in just the past few days. We wish that we could answer all of them, but time dictates that we have to narrow it down. So we're going to be focusing today on the most pressing questions that we can see are on the minds of investors. We'll get through as many as we can. These are the topics that dominated the questions we received this time. Before we get into it, I will just say that if you find this video useful or interesting, to please subscribe to the channel. Give us a like, join the discussion in the comments below. It really does help others find what we're doing here, and it means that you'll get new content as soon as it is released. That all said, Tom, welcome along. Let's get into these questions, shall we? The first one, Tom, is this. What are the chances of a market correction this year, and what is the best way to mitigate potential losses to my pension?
Well, I guess the short answer to that is that the chance of a correction this year is probably greater than it was last year or the year before or even the year before, because the market's been going up for 3 years now.
Yeah.
Since October 2022. So I guess the longer that goes on, the odds of a correction increase. It doesn't feel to me like that's the sort of central scenario. Which is always a bit worrying. And I think I'm not alone in, and I read an interesting piece over the weekend, actually, along those lines saying, isn't it strange that everyone is actually reasonably positive about the market at the moment? And they are.
Well, there's a few things going on, right? I mean, the questions, this question was representative of many that we got. It's probably the most sort of common theme was people saying, what about a correction? What about a crash?
Yeah.
Lots of people saying, well, it seems a question of not if but when. So it's funny, we've sort of lived with this kind of growing sense of a very high market for a long time, and maybe we're getting to the point where people are saying maybe we're worrying for nothing. Or
well, I think you have to say what's going to cause a market correction. I mean, significant overvaluation might be a reason for it. Yes, the US market is quite highly valued, but you look at markets around the rest of the world, doesn't feel that highly valued. So I don't think valuations by themselves are a reason to think that there's a correction around the corner. A recession, that would obviously not be good news. But if you look at the forecast for earnings growth, they've actually picked up since April, when there was a big falling away in earnings forecasts in April around the time of the tariff announcements. But throughout the second half of last year, those earnings expectations actually improved, and we're looking at double-digit earnings growth probably this year and next year. So I don't think valuations are a problem. I don't think earnings are necessarily a problem, and that sentiment doesn't actually seem. People are not sort of exuberant at the moment.
Yeah, exactly. You made the point before that the fact that people are talking about this isn't sort of the typical state just before a crash. It's not often that people say a crash is coming, and then the crash comes.
Yeah. I mean, I hate this conversation because it's famous last words.
We can look really stupid. Yeah. And just finally, things that sort of release valves for the market. There's room for central banks to cut if there were a recession, for example. There's places to go. Yeah,
that's the one thing I didn't mention. Policy does seem to be supportive. Both fiscal policy, government spending is still happening, pretty much everywhere. And monetary policy, I think on both sides of the Atlantic, certainly, the US has had 3 rate cuts at the end of last year. We've had 1. It feels like the stage is set for further interest rate cuts. It's really only Japan where interest rates are going the other way.
And just finally on this question, because I do want to get through lots today, mitigating those losses if they come, there's some sort of long-standing wisdom around
Yeah,
this.
I mean, usual stuff. I'm afraid it's be well diversified. I mentioned the fact that not every market is expensive. I think diversifying your holdings around markets which are less stretched in terms of valuations makes abundant sense. And also, just not trying to time the market, dripping your money into the market over time.
Indeed. Okay, well, the next question, Tom, is this. What are your thoughts on gold and silver investments in 2026? Interesting things happening with those assets.
Yeah, well, I mean, what's happened with both of those assets is that they've both gone up an extraordinary amount. Actually, more silver than gold last year. I mean, silver. I mean, I was writing about silver I can't remember when it was. It's some point last year when silver was about $35 an ounce. I think it touched $80 an ounce. So that's a pretty remarkable rise. But gold as well has been very strong. Gold has more than doubled in the last 3 years. I mean, there are good reasons why precious metals should have done well. They tend to be seen as a hedge against a lot of the things which investors worry about: excessive government debts, inflation, just geopolitical uncertainty. We've had all of those in spades. So I'm not surprised that that gold has done well. It feels to me like it's quite difficult to chase that market at the moment. I mean, it feels to me like it has gone up in such a sort of parabolic way that I look back at the chart over the last 30, 40, 50 years, and you can see it does this periodically. It goes vertical, and then you have a period of maybe several years in which it just goes sideways or backwards. I think that's a real risk with gold. Well, both gold and silver.
Yeah, and just dwelling on silver for a moment, because I think a lot of people have suddenly got quite interested in silver. And actually, I was doing some press work around it and was asked to talk about it. And if you look at silver tends to do well actually after long periods where gold has done well. It always gets to the point where people are like, well, what's next? Gold's done well. Don't want to buy it at these high levels. Maybe silver's next.
Yeah.
Perhaps there's a bit of that. But silver is different from gold, isn't it? There's more industrial uses for silver than there are for gold, and particularly in I'm no expert, but electric vehicles, solar paneling, lots of kind of future looking industry relies on silver. Very conductive of electricity is silver. And potentially the subject of sort of governmental oversight in places like China, where they're sort of looking at licensing for silver. They're a huge producer of silver, and lots of buying sort of in anticipation of that kind of activity.
Yes, I think both of those factors are true. And there's a third one, actually, which I was kind of unaware of until I spoke to the manager of a precious metals fund last year. And he pointed out to me that the supply of silver into the market is also an important factor. And one of the things which happened in recent years, as we all know, is that photography changed. And a lot of silver, which was used particularly in plates for X-rays, found its way back into the market because you can extract it from all these X-ray plates from the National Health Service, and it gets so. What we had was we had an excess supply of silver, which pushed down the silver price for many years, and eventually that surplus worked its way through, and that was one of the triggers for the rise in price.
And if we're going to exchange factoids about silver that we've learned, there's very little sort of dedicated silver mining. It tends to be as part of other mining that goes on, so I understand. So it's not like you can turn the taps on to get more silver. Basically, it's very much dependent on other things. So anyway, that's
good factoid.
Yeah, exactly. All right, let's move on, Tom. How should investors think about geopolitical risk when positioning portfolios for the year ahead? Well, how should they?
Well, I think that is possibly a better question, actually, because I think that by its very nature, geopolitical risk is unpredictable, and we, even just since the start of this year, things have happened which I didn't predict, were hard to predict, and more important is not the geopolitical uncertainty, because that is always there. That frankly is it. it becomes clear in hindsight, when you look back, everything seems really clear. But while you're going through it in real time, everything is uncertain. Yeah. So I don't think that what we're going through at the moment is particularly unusual in that regard. So you need to look at, what's the real impact on the global economy when deciding whether it's going to affect your decisions. That's the first point. And then the second point is, even if you know what's happened and what's going to happen, knowing how the market is going to react to that is very difficult to predict. So I think be very cautious about even thinking about geopolitical risk, because it is by its nature totally unpredictable.
Yes, you don't know if it's going to happen, and you don't know what the happen if it does happen.
Yeah.
I would say though it's just one more risk, isn't it? To throw into the mix, and investing is about investing in the face of all these uncertainties and these risks, right? And we could be moving into a phase where geopolitical events do become tied to trade and do become tied to access to important strategic minerals and all these sorts of things that will become intertwined with the markets. And I think people would be wise to expect sort of volatility, but not be perturbed.
Yeah, and I think they'd be wise to expect volatility just because of where we are in the cycle as well.
Yeah.
I mean, towards the end of a bull market, markets do tend to become more volatile. So yes, I think I'm not dismissing it. I'm just saying that when you have no control over it and you don't understand what it means, I think it's possible to overthink it and to give it too much weight in your deliberations. There are lots of other risks to do with investment which are totally predictable. Demographic changes, inflation, all those things, which people tend to rather dismiss and ignore. And they focus all their attention on these sort of more obvious risks, but actually they understand them less well, and they're less controllable and less predictable.
Okay, well, let's move on for now, Tom. Which funds do you suggest for exposure to the US, which avoid the AI stocks? Should it be US small caps or an equal weighted US tracker, perhaps?
Right. Okay. So this is someone they want exposure to the US, but they don't want to have exposure to what is perceived to be the more expensive, more vulnerable part of the market, which is a totally legitimate aspiration. So I've just done my annual fund picks. One of which is quite a good example of this. So I chose a global fund. Can I mention the fund?
Yeah. You can mention the fund.
Yeah, Dodge & Cox Worldwide Global Stock Fund. It's a global fund. It has about a 50% exposure to the US, which is considerably less than the US's weighting in global markets, about 70%. So it is underweight the US, and also the nature of the fund. It's a value focused fund. It's got some of these tech stocks. It has Alphabet, for example, as one of its top 10 holdings, but it's not really heavily weighted towards those kinds of stocks. So that feels to me like a quite a sensible way of getting an exposure to the US, but not really being weighted towards this expensive part of the US market.
It's an interesting question, isn't it? Because you might say, well, if you don't want exposure to AI, why do you want exposure to the US? Because that, as a strategy, hasn't worked, has it, for a while now? Lots of wisdom in going for more lowly valued parts of the market in the US. That's always the case. You could always make the case for the value approach. But it wouldn't have got you very far, would it, in the past few years? And so that's a decision you need to make.
It wouldn't have got you very far, but it is totally reasonable to look at the dispersion of valuations, for example, in the US market, and to say, there are parts of the US market, smaller companies, other sort of industrials, non-AI related industrials, which are actually not that expensively valued, and it might make sense to shift your exposure to that. Now, a year ago, I recommended a fund, Brown Advisory US Smaller Companies Fund, sort of on the same thinking, really, that this was a part of the market which had lagged and might catch up, and it hasn't done particularly well. So the timing of these moves is also a bit tricky.
Yes.
It may well be that undervalued part of the market over the next sort of 5 to 10 years catches up, but it may not happen in the short term.
Okay, well, let's move on for now, Tom. Bonds or cash in 2026, which do you predict will have the better return, and what percentage do you suggest in a balanced portfolio for each of those? Bonds or cash? Yes.
That is quite a tricky question, actually, because I think there is an argument for why bonds may not do particularly well this year. So the argument is this, in brief. I think interest rates are going to fall in the US and in the UK. That, on the face of it, is good news for bonds. But I think there may be a reason why longer maturity bonds, so 10 to 30-year maturity bonds, may not follow interest rates lower if people are worried about inflation, if they're worried about the levels of government debt. So actually, bond yields may even go the other way, which would not be good for bond prices. However, the counter argument is that bond yields are quite high at the moment.
Yeah.
And so you're being paid for that uncertainty to an extent. And if interest rates do come down, then the return on cash will also come down. So we may get a widening differential between the income that you can earn on a relatively safe bond and the income that you can earn on super safe cash. So it's not a simple question. I think it depends what you think about what I've just said about the divergence between cash rates and long bond yields, but also how important security of capital is. And if that's important to you, then you may well settle for a slightly lower income from cash.
Yeah, and on the cash side of things, people have had a good couple of years, haven't they, of being able to get inflation-beating returns on cash with no risk. That's great. That's exactly what you want. It looks like that's going to get harder and harder to achieve. We're almost at an inflection point in the UK where, say, the Bank of England rate is close now to where the inflation is. They might cross over soon. And once again, cash is likely to lose you money in real terms. Lots of people probably have quite big cash positions built up over the last couple of years, and they'll have to think about whether they want to redeploy that in riskier assets.
Yes, or whether they don't. I mean, I think there is still a good argument for holding some cash, and if you're able to, if you're able to get, I'm not sure what the rate is on a cash fund at the moment, but if let's say it's 4%, which sounds plausible, then actually, if you are a bit concerned about the level of the market, then a 4% return on a safe asset is still attractive. So I think there'll be a lot of people who are in cash who will be quite happy to stay there for a while.
Okay. Next question, Tom. If 2026 turns out to have serious ups and downs, would it be better from a psychological point of view to be in high-quality dividend-paying funds, companies and funds and companies, as opposed to pure growth funds for investors like me who are in their late 60s? So dividends, but then dividends for that age group as well.
Yes, I mean, I think actually there's merit in holding high dividend paying stocks, whether you're in your late 60s or not. I mean, they do have an inbuilt security because just the mathematics of it. And as the price falls, the yield rises, and that puts a floor really under the shares. I mean, not a complete floor, because yields can go, in theory, they can go up and up and up.
Yeah.
But in reality, if a share is able to pay its dividend, once it starts yielding 6%,
it's going to get bought.
It's going to get bought. Someone's going to buy it. So it does kind of put a floor under it. So I think as interest rates come down and as the returns that you can get on super safe assets like cash diminish, then the appeal of high yielding stocks is going to increase.
Yeah, and it is reassuring, isn't it, when you do have other risks out there that people are worried about. As a protection against recession, for example, a nice, very steady dividend paying, company in a defensive sector is reassuring, isn't it? And if you can get, the bulk of your return that way, for sure, it's going to be psychologically easier.
Yeah, and I think that's a really good point. I mean, the question includes that notion of psychological security, and that is so important in investment. Even if it's just something that keeps you there, keeps you in the game. You've got to sleep at night, and that's an undervalued asset.
Indeed. Okay, let's move on for now, Tom. The next question, an interesting one. If the current Prime Minister is replaced by a candidate that suggests that bond markets should be ignored, what would you advise? Now, I'm going to put some guardrails up against around this question. We're not a political podcast, Tom.
Right.
So we're not going to pass judgment on whether the Prime Minister is going to be replaced or should be replaced, certainly. But I think it is worth discussing the intersection of the bond market versus politics. We've seen and heard some politicians sort of questioning, why should we be listening to the bond market? No one elected the bond market. But why does the bond market matter to politicians? Why should they care?
Well, the bond market matters a great deal to politicians. We talked earlier on about long bond yields not necessarily following interest rates lower if there were concerns about the level of government debts or government policy in the broader sense. So bond yields matter. And why do they matter? Well, because they impact very directly the cost of paying for those government debts. And when you have a high level of debts as we do here and many countries do, in fact most countries do,
and you'll want to borrow more and more money into the future because you've got such big commitments.
Exactly. You have to keep the bond markets on side. So any politician that says we don't care what the bond market thinks, it's a kind of thing that politicians say when they're trying to be elected. It's not something they tend to say when they're in power. I mean, you only have to look at the extent to which the Chancellor focused attention on the markets, the bond market at the recent budget, to realise that once you're in a position of power and you are responsible for paying the interest on the government debts and borrowing more money to fund everything that you want to spend, you suddenly become quite attentive to the bond market's needs. So it doesn't feel to me like something that I would worry unduly about, because I think once that notional politician were in power, they would start to pay attention to the market.
Exactly the point I was going to make as well. And actually, the questioner, I think, is probably suggesting certain politicians on the left who have, sort of potentially might sort of rise to power, who've spoken about this. However, it's not party political. We had a mini budget 3 and a bit years ago, where Conservatives came in and did something really in the face of what the bond market was saying, and got badly punished for it. And also, we should say, we talk about the bond market vigilantes, and we'll often say the bond market has this opinion or that opinion, and we personify it. That's wrong, isn't it? All the bond market is a billion small investing decisions being made by people about whether they want to risk their money in this way or that way. And it's just an aggregate of that, basically. You're asking people to lend your money, really.
And it's just a measure of the conventional wisdom about the likelihood that you're going to get your money back at the time when you're due to get your money back. It's not a thing, it's not a person, it's an aggregate of lots and lots of decisions, and people are making relative judgments about whether this is more or less attractive than putting your money somewhere else.
And just finally, on the sort of government borrowing side of this, we'll often say, the bond market is worried that the government might default or not pay money back. That tends actually to be less of the concern, doesn't it? It's more like, we believe you're going to have to borrow so much money in the future that we're going to be able to demand higher prices in the future, or a higher rate of return in the future. And so therefore that tends to be an upward pressure. So it's really incumbent on the government to keep the projection for borrowing under control. That's what the bond market needs to hear.
Two things. One is keeping the amount of borrowing under control, and the other thing is keeping the inflation rate under control. Because if inflation is allowed to get out of control, to spiral, or even not to spiral, just to rise to higher levels than is desirable, then investors will demand more of a return now to compensate them for the fact that their money will be worth less in years to come. So yeah, level of borrowing and inflation are absolutely critical.
Okay. The penultimate question today, Tom. I am a grandfather making monthly investments into JISAs. Initially, the investments are into equity funds, but at what age should one start to de-risk that portfolio? And at the age of 17, 1 year from maturity, what percentage of the portfolio should be invested in equities?
Oh, that's a really interesting question, because that makes a big assumption that at 18, that money is going to be used for something, or is going to be cashed in, which is not necessarily an assumption that you would want to make. If you were very kindly, contributing money into a junior ISA, you might be doing it in the hope that you were setting up your young person for a lifetime of investing, starting at 18 and going on for the rest of their life. Yeah. Now, if that were the case, then you would think very differently in terms of asset allocation. You wouldn't want to be de-risking that in any way. So I think part of the answer to that question is, what's the money going to be used for at 18? It may well be that it's explicitly being designed as a pot to save for maybe going to university. In which case you might want to protect the value of that to make sure that it could pay for its desired outcome, paying for the university education. But if it's just part of a long-term savings plan, then 18 is a completely arbitrary age.
It is. It's a really
also
interesting
the beginning of it's very young. So
yeah. Well, first of all, congratulations to this person for being a very diligent grandfather, a generous one as well. What it strikes me, if you really think about this, it's important to sit that grandchild down at some point and tell them about some of the...
How kind you've been.
Well, that's point number one. Point number two would be about what they can expect from their pot of money that they know they've got that's now going up and down with investments, if that indeed is what happens. Because it seems likely to me that you might want to pay for the university, or you might want to pay for a house deposit 10 years after this point, or 15 years after this point. Or you might want to do something which I would advocate, which is leaving it for much, much, much longer. Yeah. I did some work looking at how long it would take you basically to save 100 grand investing money, and how much it would, if you were going to take 10 years over that, how much would you have to put away? When you do those numbers and then extrapolate it out to 20 years, to 30 years, to 40 years, the amount of time it takes you to build 100,000 shrinks right down. It might take you 10 years at the start, then it comes down to 7 years, and then 5, and then 4, and then your fifth 100,000 takes you like 3 years because of all the investment growth. Yeah, a child has that kind of really long timeline, and it would be what a legacy, what a gift to have money invested that they don't touch, and that they're later in life, and then they have this very, very healthy amount of money. Yes, but they need to be educated on the sort of whys and the wherefores, so that they don't plunder it, or they don't panic when they see it going up and down, because that will happen as well. Yes, I think that's a really good point, and I think let's say that this JISA this junior ISA has grown to I don't know, let's say £20,000. I mean, I think the education that you're talking about there is to explain to the 18-year-old that this £20,000 is worth £20,000 today, but it's so much more valuable than that, because basically what they've been given is a head start. Yeah, they've leapfrogged into those more rapid accumulation years. Yeah, and what a fantastic gift that is. And that's in an ISA. That's tax free potentially in the future, which is really, really, really valuable. Yeah. It's a sort of if you could do anything, go back in time, that's the sort of thing you would do. Absolutely. All right, the last question today, Tom. I followed your fund picks for years, the questioner says, but now I think I have too many funds. Should more recent picks carry more favour than older picks? I know you think about this a lot with your picks, actually. Well, that's quite an interesting question, isn't it? Because I mean, I would like to think that my more recent picks are more sort of attuned to what's going on in the market, and so they should be given more weight. I actually think that's probably not necessarily true. And when I actually went through the process recently of looking back, because I've been doing these
annual fund picks for 10 years now. So it started in 2016. And when I go back to 2016, actually some of my best fund picks were right at the start. So I remember in 2016, I recommended the Rathbone Global Opportunities Fund all the way back then, and it's done fantastically well over that 10-year period. So would I give that less weighting than the more recent ones? Well, no. I mean, actually, my only regret is I didn't put more into that one 10 years ago because it's been so good. So no, I hear the question, and I hear the sort of, the uncertainty in the question. You've built up this portfolio of lots of different funds. How do you narrow that down? And I don't really know the answer to that, other than to look at them all today and to make a judgment about,
is that case still intact?
Is that case still intact? Does it still make sense?
Yeah, and I'll just point people here to your fund picks. They kind of come out at this sort of time of year, around the same time as the Outlook. We're going to record an episode that run through the specific fund picks that you've made. So if anyone wants those, keep an eye on the channel. You'll see it in the next week or so. But yeah, this question of how many funds overall, you can get to the stage where you have too many, can't you? Especially if they're doing sort of overlapping things, different things. Sometimes what you can end up doing is basically replicating buying the entire market, but just in a bit more of an expensive way, in a bit more fiddly way through these active funds. You do need to be prudent along the way, but it's not a problem to hang on to funds for several years. In fact, that's what you should be doing.
Absolutely. And in fact, if I've learned anything from making these recommendations over the last 10 years, it is that buying and holding is a good strategy, because very often the benefit of and it's not because I'm particularly sort of far-sighted or whatever, it's just that sometimes that's how it works. You don't get the benefit initially, and then over time it just it compounds up into a really fantastic return. But it may be that it's in years 5, 6 and 7 that you get the real benefit, and it builds on what you've already achieved.
Okay, Tom, well, let's leave it there for now. That is all the time we have for questions. A full copy of Tom's Investment Outlook is available to download at fidelity.co.uk/outlook. Thank you so much for watching. And Tom, thank you for joining me.
Thanks, Ed.